Hi, everyone. Just welcome for the top 500 questions. These are the 500 questions which I've selected, which perhaps covers everything from the syllabus point of view. Now, in reality, for each reading, you have limited questions in exam. For example, we are starting with QM, where the weightage is 6 to 9%. So you can expect roughly 12, 14 questions. Now, if you see the number of readings that you have in QM is also around the same. So many students take an average that on an average, you are going to get one question out of each reading. Now that is too much from the reading is too much and the number of questions are very less comparatively. So in CFA, this goes right. Now, of course, in level one, there is nothing that you can skip. However, there are some of the topics which are too lengthy, but you don't have to go in deeper of that because the CFA Institute has a history of not asking too complex things. Yes, they are going to be tricky, but nothing is going to be out of the box. Everything is going to be from the syllabus. Most of the students have problem with the last readings of quants, I'm sure, hypothesis, linear regression, parametric, and so on, right? These are the topics where students are worried, but honestly speaking, they don't ask you too many questions from it, right? This is what I'm saying you from my experience. Of course, I cannot officially say that, some student told me otherwise. It's a violation of which code? Which code? Violation of code of conduct 7? 7, right? Correct. So I cannot officially say that. But yes, the reality is that the hypothesis linear regression, which students are generally too much worried about, that they should not be worried about. The important thing is that the initial topic questions are very important for your rates and returns, time value of money, statistics, sampling. These are very important questions. Ironically, if you see in the quants part, many things which are related to equity, currency, all of them are also mixed up. Portfolio, all of them are also mixed up. So quants is a combination of everything. If you don't start with quants, it's a problem. So in reality, even when I teach the full course or the fast track, I start with quants because that makes a foundation very well. Now there are small concepts too much in detail, right? So all of that I've summarized in the revision book. You can watch the revision book if you have. That is going to be very easy because that covers almost all the concepts. Okay. And I've summarized everything in 2 books. So all your 10 topics are summarized in 2 books. I suggest you watch from that so that all the formulas and concepts are covered. Now, again, since we are starting with this top 500 questions, so around 50 to 60 questions of each of the topics I've selected, starting in the same flow as what I do in my full course lectures. So we'll first start with cons and then we'll proceed further, okay? The questions and the solution note will be uploaded along with the video, which you can watch it later, right? Any questions related to outside the concept, you can ask me at the end of the session, right? Right now, we'll focus only on the questions related to the concepts, correct? There might be, not everyone is basically not everyone has done CFA level 1 from me in this batch. So you might not be aware of the technique that I used, but I'm actually going to use the same technique that I use in my YouTube channel or in my full course and so on. Some of the questions that you might feel, oh, they are tricky, I'm not able to understand how this is solved, you can unmute and ask me. You can also raise your hand on the chat box and ask me. Otherwise, I would suggest you to keep your mics on a mute so that there's no distraction or disturbance in the recording. All set? In between, I expect you all to be very proactive on the chat box where you can keep me yes, no, hi, hello, whatever. You can keep pinging on the chat box. Make the maximum utilize of these live lectures for the concepts. Rest all, don't worry, right? CFA is where you don't need to overthink. Okay. Also, I have a question, so I'll just give you an idea. In the next 10 sessions, we will or in the next 10 parts, you will see each topic. So each topic we will go through the flow. All the details of what the flow and everything is, I'll be sharing up in the group as well. Okay, so we will first start with quants, right? All the topic I have arranged in a manner that they are interconnected. You have to do one thing, is that consider this 1 2 hour session as your refresher of going through all the topics, all the questions in a nutshell, right? Rest, apart from this, I always recommend you to go to the CFA Institute questions to do any additional questions that you want. Doing any extra question is no harm. But don't do so many things that you don't have time to revise. Revise, do questions. Revise, do questions. All the general tips and guidance we can discuss at the end of the session, right? Let's start with the session and not waste too much of your time because quants is lengthy and we will focus on the quants. Perfect. Let's start with the quants. Everyone all set your calculator, book, pen, notes ready. In some of the case, hardly you might require to do manually. Otherwise, you can follow with me as well. All set with your calculators, all charged up. Generally in the live session, people are a bit boring. They don't reply. They just said, all you have to do is yes, no, yes, no, yes, no. Make me feel that you all are with me. Otherwise, I feel sometimes I'm just in front of a mirror. Okay, perfect. All set. Let's start.
Okay, sir.
Yeah. Okay. First, the first question, the nominal risk-free rate is the best described as the sum of real risk-free and a premium for you can put up in the chat box also. See, this is basically the Fisher effect, right? The Fisher effect you see this in economics also. So the nominal risk-free is a combination of real risk-free plus a premium for inflation. Plus a premium for inflation. So we have inflation premium when they ask me nominal risk-free rate, correct? So it is a premium for inflation. The other premiums, risk premium for maturity, liquidity, and default or credit risk premium, these are when you are looking for nominal rate, not nominal risk-free rate. Nominal risk-free rate is also the rate for government securities. Am I correct? Check, check, check. Right? Okay. Second, consider the following annual return for the past 5 years. You've been provided with returns positive, negative, positive, positive, positive. The geometric mean, guys, geometric mean is also the compounded return. Am I correct? So how do we process the geometric mean? You need to do that in the factor, in terms of factor. So 19.5, how are we going to process 19.5 in our calculator? It will be 1.195, right? Times. Now, guys, see, you can do 1.195, store it, or you can keep it, you can directly keep on multiplying also. But sometimes when there is negative, how do I solve 1.9 negative percentage? Okay, so in your calculator, you can put 1.9, correct? Negative sign, then press percentage and press 1. Then press percentage and press 1. Are you getting 0.981? Correct? Are you getting 0.981? Check, check, check. Then 1.197, 1.35, and 1.057. All of this multiplied to the power. Since this is 5 years, we have to do to the power
One.
1 over 5 minus 1. This is my compounded return. Everyone with me? Right? So let's solve this. 1.195 into 0.981 into 1.197 into 1.35 into 1.057. When you get multiplied all 5, press equal to and then store 1. Can you tell me when you press equal to multiplying all, what is the number you're getting? Are you getting 2.0023? Something like this? Check, check, check. Please let me know. Are you getting this number? Hello, everyone in the class. Yes, okay,
Yes, sir. Yes, sir.
perfect. Then press YX. YX is the power. YX 5 and inverse. So you'll press YX 5 and inverse it. How do you inverse it? 1 by X. Then press equal to. Once you do that, you'll get 1.149 minus 1 into 100. You will get 14.89 or roughly 14.9 percentage. Everyone getting this? Check, check, check. Anyone not getting it? Please raise your hand. Perfect. Got it. What is critical? The negative part. How do you solve this? Again, you put 1.9 negative percentage sign and then add 1. You will get this. All set? Anyone, any issue? Raise your hand. or just give me a thumbs up. If you get the answer, you have to do compulsory thumbs up. If those who do not give me thumbs up for not getting the answer, they have a $1,000 fine. How much fine will I collect? Wow, great. Hello? Getting the answer, not getting the
Sir,
answer?
uh, sir,
Yes, please. Go ahead.
sir, could you explain y to the power x minus 5 and the
Yeah,
x?
because it's compounded geometric mean. So geometric mean, we always compound. So it's not arithmetic average. Arithmetic average, you divide it by 5. Compounded returns, you compound it over the period. It's this return, this 14.9 is the weighted average return. So if you do 14.9, compound it for 5 years, you would probably get the same numbers. So when I say compounded means it takes into the factor the reinvestment. Understood? So therefore we do to the power. When I do to the power, it is compounded. So it takes into factor the reinvestment. Clear? Also, I'm sure you all are aware, arithmetic mean is always greater than geometric mean or less than. Please, everyone reply. Arithmetic is always. Check, check, check. Hello, everyone out there. You have to reply. How many are there? Yeah, so many. Yeah, arithmetic mean is always greater than, less than geometric mean. Please tell me, everyone. Arithmetic is always and always greater than geometric mean. In fact, if you extend the relationship, arithmetic is greater than geometric, which is greater than harmonic, but arithmetic and geometric mean are comparable. Understood? Arithmetic is always higher, geometric is slightly lower. In exam, they will tell you clearly whether they want arithmetic or geometric mean. Everyone with me? Check, check, check. Right? Okay. Now, one question which I expect the CFA Institute to test very often, they do that in the past, they've done in the past also, is the concept of money weighted and time weighted return. Are you aware about this money weighted and time weighted returns? Everyone? Now, there is a very tricky and very interesting question about money weighted and time weighted. We will solve this question where I will tell you the process of solving it, but there is a technique. Those who are aware about this technique, they can probably understand the technique that I'm using. Otherwise, you will have to follow what exactly I'm trying to say here. When I am looking for money weighted returns is basically nothing but IRR. Money weighted rate of return is nothing but IRR. IRR. IRR is a function in your calculator which you use in corporate issue also. Now, the tricky thing about this question, it's a very interesting thing. Whenever we do money weighted return, we think from the cash flow point of view, cash inflow and outflow point of view. But then there is something called time weighted rate of return. Time weighted rate of return is nothing but the geometric mean of the each year returns or holding period returns. So in reality, if you look at this question, without even solving the question, my answer is ready. You know how? Because they ask me that the fund's investment at the beginning of the each year generates returns for the 3 years is given, right? They've given me information, asset under management and return for each period. And then see the tricky thing. What return measure over the 3 year period is negative? Means out of the three returns, which one is negative? Now, what is the twist here? Guys, the twist here is that geometric mean and time weighted rate of return are the same thing. They are not two different things. They are same only. Time weighted and geometric return are same thing. So of course, both cannot be the answer, right? So naturally, the answer, even without calculation, is, are you getting my point? Yes or no? I'll do the calculation, but without calculation, have you understood what the reality is? The institute is testing whether you know the difference or not. So many students are worried which return, but the geometric mean and time weighted return are the same thing. So of course the answer is money weighted return, but now I will also prove how money weighted return, correct? So they are asking out of the three return, which one is negative. So how do we process money weighted rate of return? Please watch here. This is a slightly lengthy process. You have to think from the cash flow point of view. Everyone with me? Now see here. It's a 3 year investment, correct? 3 year. So initially, how much is the amount that I invested? 1 year, 2 year, And at the end of third year, how much is going to be my investment, right? So can you tell me at what amount did the investment begin with? The investment begin with, everyone in the class?
1,000.
1,000, right? So I had 1,000 basically with me, correct? So we started with 1,000 investments. Now, is this an inflow or outflow? This is an outflow, right? So I write the sign negative because you have to think from the cash flow point of view. So we write 1,000 negative. Now, at the end of the year, the return, the fund generated 15% return. So can I say 1,000 into 1.15? That will translate to 1,150. Am I correct? Right? However, they have said that the asset under management was 4,000. How much was the asset under management? 4,000. Now, how come the fund value went from 1,150 to 4,000? That means I must have invested additionally, isn't it? So the fund value went on from 1,150 to 4,000. That means we must have additionally invested how much? Everyone understood this? Check, check, check. We must have invested this amount, yes or no? Perfect. Why? Because see, 1,150 was the returns and the value of the fund, right? But they said that the ending asset under management was 4,000. So how come from 1,150 it went to 4,000? That means I must have invested additionally 2,850. Am I correct? Right? Now, the fund's value at the end of the first year was 4,000, on which the fund generated 14%. So if you do 4,000 into 1.14, the fund's value should be 4,560. Am I correct? But they said that the value of the fund was 45,000. Why did it become 45,000? Because I must have invested additional amount, right? So how much should I have? I must have invested, everyone. Am I correct? 40,440, right? And then in the final year, the fund gave 4% negative. 4% negative means your 45,000 into 0.96. Why 0.96? Less 4%. Less 4% from 100 is 0.96. So your final year value will be 43,200. But this is the value that you will exit. So this I will write plus. So if you now think from the cash flows point of view, initially I have 1,000 invested, then 2,850 also invested, then 40,440 invested, and finally the last value is the ending value, which we assume that we must have withdrawn this. Everyone with me on this? Correct, 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 correct. Check, check, check. Right? Now, can you go to the cash flow function? Everyone, can you press CF? CF just besides 2. CF and then press second clear. Go to the cash flow function, press second and then press clear to erase the previous number. Have you done that? Now, what's on your screen? You have CF0. CF0. Guys, we are not putting anything at the beginning. Are we putting anything at the beginning? Yes or no? CF0, yes or no? Are we putting anything at the beginning of the investment? Everyone in the class? At the first year, yes, we have invested 1,000. So my CF0 will be 1,000 negative. First year will be 2,850 negative C01. I'll repeat the process, don't worry. 40,440 also negative, and C03 is 43,200. Enter IRR, compute. You will get an IRR of negative 2.22. I will explain you again how. 2.22. For those who know how to calculate IRR, this will be the case. Now, those who want to repeat the process and understand, everyone, see 1,000 I invested at the beginning immediately. So this will go into my CF0. So your CF0 will be 1,000 negative. C01 should be 2,850 negative. Ignore the frequency. Frequency is same. You keep the frequency one only. You don't change the frequency. Then this has to be your C02. This has to be your C03. Once you put all the numbers, IRR and compute, you should get this. Are you getting this, everyone in the class? Check, check, check. Confirm me in the chat box if you've got this answer. Everyone. This is money weighted rate of return where you need to think from the cash flow point of view. Everyone, all set? Got it? Okay. The first topic and the second topic has many small concepts. Okay. Most of these concepts are repeated in equity, derivatives, fixed income, and so on. How do we do IRR? Could you please give a brief? All you have to do is press all the functions and then press all the numbers in your cash flow function and then press IRR. You have an IRR button, press IRR and compute. IRR compute. You go to the cash flow function. I put the cash flow function here, second, clear. Then put in CF0 1000 negative, C01 this, C02, C03 should be positive. Once you put all the numbers, press IRR and compute. IRR and compute. You should get this. It's the exact same function that you use in corporate issue also, right? In project financing. Got it, everyone? Yes. Perfect. Let's move to the next one. The price of the stock initially is 208.25. This is the beginning value. Ending value is 186. So the value have dropped. Now they have asked me continuously compounded rate of return. Guys, whenever they use the continuous compounded rate of return, we use a function. First of all, what is the ending value? Ending value divided by beginning value. How much is the ending value? 186.75. And the beginning value is 208.25. Now, generally we use ending over beginning formula to calculate the holding period return. But if they use the word continuously compounded, you have to do one more thing, is that you have to apply log natural. Log natural is the continuously compounded rate of return. So here, what you will have to do is that ending over beginning, first you solve ending over beginning. What is ending? 186.75 divided by 208.25. Press equal to, you should get 0.8968. Then press ln. Ln is just beside 7. Once you press ln, you will get an answer. Yes. Are you getting minus 10.9? When should I use this ln function? Whenever you see the word continuously compounded rate of return, you should use ln, log natural. Understood? Everyone? Check, check, check. Perfect. Okay. Now see this. Now there is a concept which generally is tested in equities, but they have also asked that in QM. So leverage return is a concept that can be tested in equities also and also in QM. Okay. What is leverage return? Leverage returns comes in place when you are investing with the help of debt. That's your leverage returns. Okay. So let us see the process here. And equity portfolio of 25 million is financed with 20% debt. So guys, how much will be my debt? My debt 20% of 25 million. Can I say it's 5 million? So my equity will be 20 million and my total portfolio is 25 million. Everyone with me? Understood. Hello. So out of the 25 million portfolio, 5 million, that is 20% is debt. 20 is my own money. That is equity, correct? Now they said that the portfolio is financed with 20% debt with 6% annual cost. So how much is going to be my interest? 6% on the borrowed fund of 5 million. So 5 into 6%. So my interest is going to be 0.03 million, right? And they said if that the portfolio generates 10% return, 10% annual total invested returns. So guys, my returns will be 10% on the whole portfolio of 25 million. That is going to be 2.5 million. Am I correct? But since I have used leverage, what will be my leverage returns? From this return, I will subtract the interest, isn't it? Divide by my own investment. So this is going to be my net returns after subtracting. What is my own investment? Is it 20 or 25? It's 20. Am I correct? My equity is only 20, not 25. Right? Correct, everyone? Check out how much is your returns, everyone. So this is going to be 2.2 divided by 20 into 100. You should get 11%. Remember, in leverage return, whatever is the total return, from that you subtract the interest, divide by your equity. Equity is your investments, not the leveraged investments. Understood? It's same like return on investment formula. Perfect. All set, everyone? I took one example of money weighted. I wanted to show another example of time weighted so that you can understand how both are calculated differently. When you do money weighted, you have to think from the cash flow point of view. When you do time weighted, you have to think from the holding period returns point of view. And then, remember, I told you, then you have to do the geometric mean. Okay. So, what is holding period return? Holding period is simply ending over beginning. Okay. Minus 1 into 100. So, ending, if they give you only stock price, you take the ending value. But if they give you dividend, it will be ending plus dividend. Okay. For example, see here, investor buys a share at 50 today, another at 75, and sells both at 100 at the end of second year. Dividends of 5 in first year and 7.5 in second year was given, and they have asked us to find time weighted rate of return. All you have to think is from the point of view of holding period return. So imagine this is a stock. What is the stock's performance? The stock started at 50 at the first year and ended at 75. But don't forget, in the first year, it also paid $5 as dividend. So what is going to be my ending value? Will my ending value be only 75 or 75 plus 5? It has to be 75 plus 5. Am I correct? Because you are also going to get the dividends. Am I correct? Check, check, check. Right? So my ending value will be 75 plus 5, and the beginning value was 50. All I want in your calculator is 80 divided by 50. You will get 1.6. I just want you to store 1.6 somewhere. 1.6. Just store it. Store 1. 1.6 is a factor. In reality, the return is 60%. 1.6, we actually do holding period is minus 1 into 100. You don't have to do that here. Just do ending over beginning and store it. 1.6. Have you stored 1.6? Now look at second year. In second year, the stock's value went out to be 100 and they gave a dividend of 7.5. So I would do 100 plus 7.5. And what was the value a year before? 75. So do this 107.5 divided by 75. You would get a value of 1.433. Right? Perfect. Now, all you have to do is geometric mean. You have to compound both. So I will do 1.6 into 1.433. Since it's 2 years, you can do to the power 1 by 2, or you can simply do square root. Yes. So I will do recall 1 times recall 2 equal to, and then simply press square root because it's 2 years. So once you do square root and minus 1, you should get an answer of 51.44. Are you getting that? That's my answer A. Check, 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 check. All set. Understood, everyone? Perfect. Yes. Clear? Again, time weighted return is where you calculate holding period return for each year and then compound them into the geometric return. That is why we call time weighted return same as geometric mean. Isn't it? Understood? Yes. Now, next one. A stated rate of 9 percentage. Whenever they say stated is nothing but nominal rate. Stated is nothing but nominal rate. Sorry, nominal rate is 9%. And then they said compounded continuously. So what is compounding frequency? Yes, I have a question. Yes, go ahead. Yes.
In the question number 6,
Hmm.
why have they mentioned the required return equals to 35%? When it came no use.
It's no use. It's no use because time weighted return is different completely. That is just to lure you into believing something. So, sometimes what happens in the question, they give you unnecessary information. So, what we always do is that we think what we need, we only use that information. They have this habit of putting traps. So, whatever, see, the concepts are simple. What they can do is that they can just put something tricky. So, that 35% is just like a trap, it has got no use. Got it? Right? Okay. Now, nominal return, everyone, all clear that doubt? Hello, whosoever had that doubt, check, 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 check.
Yes,
Understood?
sir.
Yes, okay. Now, coming back to question number 7, stated return means the nominal returns. Now, compounded continuously. Actually, there are multiple ways to solve compounded continuously. You can use the exponential function also. Generally, I avoid doing that because that creates a lot of complication. Whenever they say compounded continuously, so the compounded frequency, you can put 999. You can put 999 as a random number. You can actually exceed it to 99999 also. It doesn't matter. Why? Because continuously compounded is infinite compound, right? For example, semi-annual compounding twice, quarterly 4, monthly 12, daily 365. Continuously compounded, you can put 999. Got it? Now they are asking me what is going to be the effective annual rate. Now definitely I know that nominal rate when compounded, it's going to be more than the nominal rate, the effective rate, right? Effective rate is always higher than the nominal rate when compounded frequency is higher. Correct? So the answer has to be greater than 9. How do I solve this? Go to the calculator function second 2. Can you press second 2, second 2, second 2? Once you press second 2, it asks nominal. Put 9, enter, then press down arrow twice. Twice you press down arrow, the compounded C by Y, you have to press 999 on my screen and press enter. Once you press enter, go up arrow, put up arrow, go to effective and then press compute. Once you press compute, can you tell me what do you get? Are you getting this as the answer? Effective 9.41. The closest to that is A. Everyone, check, check, check. Got it? Perfect. All guys. Hello, friends. Have you got the answer? Check, check, check. Just put up on the chat box if you've got the answer. If not, let me know. Right? Okay. Okay, let's go to the next one. This is a question of a mortgage. Okay. KRD Real Estate wants a fully amortizing fixed rate 5-year mortgage. So my N is going to be 5 years to finance 75% of the purchase of a building of New Zealand dollar 5 million. So guys, my loan value, my loan amount, which is actually nothing but my present value, will be 75% of 5 million. So 5 into 0.75, that is 3.75 million. Am I correct? Right? 3.75 million. Annual rate is 4.8. So my I by Y is going to be 4.8 percentage. But the question says that what is going to be the monthly payment? When they say monthly, the N will be multiplied by 12. The rate of interest will be divided by 12. Am I correct? What about FV? FE, the final value or the future value. In a loan, the future value is always zero because after paying the last installment, there is no balance. Correct? By doing this 12 adjustment, I have converted everything into monthly. All I have to do is that go to the function and then press compute PMT. That's going to be my annuity. But there is a twist. Remember a rule that I say in the class that the PV and FV, yes, does someone remember from my lecture? PV and FV, PV and FV, hello? PV and FV should not have different sign. Are you with me? So here you need to put the PV as negative, otherwise your answer will be error. PV and FV cannot have the same sign. If you put both as same sign, your answer might be error or something wrong. Got it, everyone? So you have to put 3.75 negative, then press PV. 0 as FV, 5 into 12 as N. And now don't do manually, okay? Do it in the calculator. 4.8 divided by 12. Then press I by Y and then press compute PMT. You will get an answer in 0.0. What you can do is that final answer, you can multiply that with 1 million. When you do that, you get 70,424.03. Check, check, check. Are you getting this? Yes, no? Everyone? Perfect. Clear? Understood the process, right? Even though you get the answer, process is important. Okay. Next. Swiss Confederation zero coupon bond has a par value of CHF 100. Maturity 12 years, current price is 89. Correct? In 3 years, the price is expected to be 95.25. If purchased today, the bond's expected annual return. Now, I want to find expected annual return, right? Now, see, this is a annual return. You can also do what? You can do the cash flow function. You can do it manually also. If I want to do the calculated timeline function, what is going to be my PV here and FV and N and PMT? The final one will be compute I by Y. This is something I'm looking for. Can someone tell me what is my PV here? 89, 89 negative. Am I correct? Because today's price is 89. So I must have invested at 89. So 89 negative. They are saying in 3 years, the price is expected to be 95.25. So this is when I'm going to sell 95.25 and 3 years. Since it's a zero coupon bond, your PMT should be zero. Put all of this 99 negative PV, 95.25 FV, 0 PMT because it's a zero coupon bond, 3 and compute I by Y. Are you getting 2.288? Which is nothing but C. Check, check, check. Let me know if you're getting this. Perfect. Okay. Now see, ideally this question is from bond. Okay, but you should be ready if it is asked in quants. Okay, because in the second topic of time value, they have actually mixed up everything. In fact, you will see the next question related to equity valuation, and then some of the questions from currency also. Everything they've made cocktail in the second topic. Okay. So look at the second question. Analyst observes that the benchmark Indian Nifty 50 stock index is trading at a forward PE of 15. So this is the actual PE ratio, 15. So this is actually a question of equity. Okay. The expected payout ratio is 50%, required return and growth rate is given. This is actually information related to, if you remember, it's justified PE ratio. What is justified PE ratio? Justified PE ratio, let me tell you the formula, is payout ratio over R minus G, that is required rate of return minus the growth. They've given me the payout ratio is 0.5, 50% is 0.5, and then required return 7.5 minus 4.5, that is simply 3%. Correct? So can we find what should be the PE ratio? 0.5 divided by 3%, this is 16.67. See, I understand this is a question of equity, so people might be wondering, why is this asking quants? Guys, after finishing all the 10 topics, you are expected to know anything and everything. Okay. So 16.6 is what I believe my PE should be. But in the market, the stock is trading at a PE of only 15. Isn't it cheaper? Right? So can I say the stock is undervalued or overvalued?
Undervalued.
Undervalued, right? Because I believe it should be 16. And in the market, it is only available at 15. So I can say the analyst should view that the Nifty is underpriced or undervalued. Check, check, check. This again, completely related to equity. When I generally do quants, I avoid all this thing because quants is the first topic. We do all these questions after we finish equity and all, right? But now it's okay. We are prepared for both, right? All set? Okay. Now, question number 11 is very interesting. Okay. It's somewhat related to corporate issuers. You require an 8% rate of return. This is 8% is your discounting rate, I by Y. Okay. You must invest 500,000, 500. So all of these are in thousands. And they have given you two options. They are asking you which one should you prefer. Now, before looking at the choice, I want to see which one I prefer. Now, what generally people do is that they calculate the NPV of each. You can calculate the NPV of this, NPV of this, and see whether there is a difference. There is also another way when they want you to compare. All you can do is that you can calculate the difference between 1 and 2. So suppose I subtract 1 and 2, what is going to be the difference in the first year of the cash flow? Between 1 and 2, 195 minus 225. This is going to be minus 30, am I correct? Second year will be 0. Third year will be 195 minus 160.008. You will get this as 34.992. Are you getting this, everyone? I just did the difference between 1 and 2. 1 minus 2. These are my cash flows. Now, what you need to do is that you need to go to the cash flow function, put this in C01, C02, and C03. Go to the cash flow function, second clear. C01 is 30 negative. C02 is 0. So you have to put 0, enter. C03 is 34.992, enter. And then press NPV. As soon as you press NPV, it asks you what is the discounting rate, which is 8. So press 8, enter. And then when you compute the NPV, you'll get a surprising thing. What is the surprise here? What is the answer that you're getting? Yes, when you put all the numbers, what is the answer that you're getting? You should get 0. Are you getting 0? Check and confirm. If you're getting 0, that means both the project has no difference. I'm indifferent between both the opportunities. Are you getting it? So if the difference between both turns out to be 0, that means both are indifferent for me. Now, there are many ways of doing it. Some students might prefer to individually calculate the NPV, then compare. No harm in it. You can do that as well. Or you can simply take the difference. Understood? I'll repeat. You can individually calculate the NPV of each, compare and see the value will be same. Or take the difference, put up in the cash flow, calculate the NPV, you will get the same answer. Yes, I've got a question. Go ahead. Yes.
Yes, sir. So if we do that individually, then in CF0, should we put a minus 500?
Right. You'll put minus 500. Then C01, you will put these values 195, 195, 195. You press NPV, put the I, you will get a present value. Store it. Do the same for second one, right? You will have to just change two cash flows. This and this cash flow you'll have to rewrite. Find the NPV, both will be almost same. Understood?
Got it.
You can do this also, you can take the difference also, no problem. Anything, both will result in the same outcome. Got it?
Yes, sir.
Perfect. Yes. See here in the syllabus, they have put currency questions also, which actually comes up in economics. But as I said, quants have everything, right? So this is basically a no arbitrage forward rate from the economics. If you remember what is no arbitrage forward rate, no arbitrage forward is actually spot into 1 plus risk-free rate of the price currency over the base currency. Now, what is the base currency for those who know from the economics? The second currency is the base currency. So to find the forward, I require the spot rate. They've given me spot rate as 1.025 into 1 plus I need to take the interest rate of price currency. Price currency here is US dollar. US dollar interest rate is 3.25. So I have to do 1.0325 and euro interest rate is 0.75%. That is 1.0075. When you solve this, you'll get the no arbitrage forward. This is derived from interest rate parity. This is the question of economics, right? So if you do 1.025 into 1.0325 divide by 1.0075, you will get 1.0504. Are you getting this? 1.0504. Check, 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 check. Roughly. That 1.0504 is closest to A. Understood, everyone? This is interest rate parity in economics. Okay. But yes, you have to be ready for it. Next, investor receives a dividend of 50, 75, 100, and 125 for the next 4 years. The present value that equals and 50 annuity. What is 50 annuity? Means if you take 50 from all four, how much are you left in the first year? In the first year, you are left with 0. In the second year, if you pull out the 50, you are left with 25. Third year, out of 150 gone, 50. And fourth year, it will be 75. So if you pull out a 50 annuity, then what are the cash flows that remains? That's called the cash flow additivity principle. Cash flow additivity principle is how can you break down the same concept. So these cash flow, if I pull out the 50 annuity, 50 from each, the balance is what? Then I have to calculate as the present value. So they are asking me the present value equals 50 annuity plus what? Plus this cash flows. Am I correct? Which is my answer C, isn't it? 0, 25, 50, and 75. What does it mean? That if you take the present value of this and if you take the present value of 50, it is going to give you the same outcome as the present value of all these cash flows. Of course, we can't calculate the present value as of now because we don't have the discounting rate. But if you ignore the discounting rate, the amount will be same. Got it? So it's more of a logical question rather than any calculation question. Understood, everyone? Right? This is not so important concept, but I have seen this somewhere, randomly thrown up in form of a question. It's more like a logical reasoning, not like an actual cons. Got it? Okay. Next, question number 4, again related to loan. A 15,000 loan is paid over 5 years with monthly payments at 12%. What is the monthly payment? Guys, 15,000 will be my
Present value.
PV, but don't forget to make it negative and FV will always be 0. N will be 5 into 12 because it's monthly payments and I by Y 12 over 12. All you have to do is compute PMT. Go ahead, let me do that. 15,000 negative PV 0. FV loan always FV is 0. 2, 12 into 5 is your N. 1 will be your I by Y. Compute PMT. Are you getting 333.67, which is roughly 334? Check, check, check. Right? Okay. Well, these are most of the questions. Those are related to the first two topics, if you recollect. Now we will go into the third topic, which is related to statistics. Correct? Very interesting topic. Topic number 3. That is what you will see the question. Some things are similar. For example, here if you notice, they're asking me company's earnings grew at these percentage 1, 2, 3, 4, 5, 6. The average compounded annual growth, guys, whenever they say average annual compounded growth rate, or sometimes we use this term called CAGR. CAGR is compounded annualized growth rate, if you remember, which is simply nothing but the geometric mean. How do I find the geometric mean? See, the name has changed. The process is the same, isn't it? So how do I calculate the geometric mean? 1.1 into 1.14 into 1.12 into 1.1 into negative 10 is 0.9 into 1.12. How many has 1, 2, 3, 4, 5, 6 to the power 1 over 6 minus 1. Let me know what's your answer. 1 into 1.14 into 1.12 into 1.1 into 0.9 into 112 equal to yx 6 inverse minus 1 into 100. Are you getting 7.67? Check, check, check. Everyone, let me know if you're getting this. Also, if you notice, if you just simply add all, although you don't require this, but if you do 10 plus 14 plus 12 plus 10 minus 10 plus 12, you will see you get 48 divided by 6, that is 8. 8 is arithmetic mean. Geometric has to be lower than arithmetic mean. So it has to be anything which is below 8, that is only B. So you can use that also as an alternative. I'll repeat, arithmetic mean is 8, geometric has to be below 8. The only choice below 8 is B. Correct? Perfect. Okay. Next, mean absolute deviation. What is mean absolute deviation? Mean absolute deviation. See, each year you have number 25, 15, 35. I'll rather write here 25, 15, 35, 45, and 55. What you need to do is that you need to subtract mean from it and only take the absolute values and sum it up. What is the mean? 25 plus 15, 25 plus 15 plus 35 plus 45 plus 55 divided by 1, 2, 3, 4, 5. What's your mean? Is your mean 35? Let me know if your mean is 35. So if your mean is 35, all you need to do is that adjust, subtract the mean from it. So, and take the absolute values, ignore the sign. So 25 minus 35, even it is minus 10, you will keep 10 only. This is going to be 20, 0, 10, and 20. So your total is going to be 60. But to calculate mean absolute deviation, you take 60 divided by, yes, anybody? 60 divided by n minus 1 or n. You only do n. In standard deviation, you do n minus 1. Here you have to do divide by 5, everyone. So you get 60 divide by 5. That's your mean absolute deviation, which is 12 percentage or 12. If there is no percentage, you can also ignore it. You can keep it 12. Understood? Remember, mean absolute deviation, you divide it by n. Some students get confused this with standard deviation and then they divide it by n minus 1. No. Clear? Understood? We took the absolute value, right? Next is a concept which I have seen. They have actually removed it from the syllabus. But if you see my videos, I am still teaching that concept because I see that asked in exam. That is finding the quartiles or quantiles. Okay. So when they say what is the third quartile, one quartile is 25%, third quartile is 75%. This is basically the concept called location. How to find the location? There is a formula. Location is n plus 1 into the percentile. So here, how many numbers I have? 1, 2, 3, 4, 5, 6, 7. So 7 plus 1 is 8 into third quartile is 75% or percentile. This basically is my sixth position. So sixth position is my third quartile. But before that, you need to arrange the data in an order. So order, ascending order, which is the lowest number I will start with? I'll start with the lowest is 7. Am I correct? Then I have 10. Then I have 12. Then I have 15, 4, 20, 23, and 27. I have to look out for the sixth value. 1, 2, 3, 4, 5, 6. That sixth is my third quartile. What do I mean by that? All the numbers below this are in the bottom 75%. Understood, everyone? Check, check, check. Clear, clear, clear. First, you need to know the formula. You need to find the position and arrange the order and choose. Are you getting this, everyone? Clear? Many students might not be aware about this if they haven't watched my video, because in many of the institutes notes, I have seen that this is missing because the CFA Institute has also pulled it out. But ironically, it was there in the previous syllabus, and they also test in some of the questions. So I don't know why did they remove it. Got it, everyone? Okay. Now, normal distribution has one very important property: mean, median, mode, all are same. Correct? If the distribution is normal. But if it is skewed, then the order doesn't remain the same. So who gets affected by the skewness? Mean, the most, right? So when they say negatively skewed, what is the relationship? Negatively skewed means mean, median, and mode. Mean will be the lowest. Mean will be lower than median, which will be lower than mode if it's a negatively skewed. If it's positively skewed, mean is the biggest. Now, what is the question asking? They're asking what is the order from lowest to highest. Lowest will be, of course, the lowest. Since it's negatively skewed, the lowest will be mean. So anything which starts with mean, then median, and then mode. This is going to be the order. Everyone understood? Check, check, check. Positively skewed, it will be mode, median, and mean. Am I correct, everyone? Understood this point? Okay. Next, for the past 3 years, ACME has generated the following sample returns on equity ROE. They've given 4, 10, and 1%. What is the sample variance? Guys, now to do the sample variance, you can do manually also, but I suggest you to use the function. Which function do we use, guys? Second 7. You can clear first, second clear, second clear, second 7, second clear, right? In your x01, you will put 4, enter, y, skip y, x02, 10, enter, x03, 1, enter. When you put all the values, x01, x02, and x03, ignore the y. What do we do after putting all the values? We press second 8. Now, everyone in the class has to tell me what is on their screen when they press second 8. Put up in the chat box. Let me know when you press second 8, what's on your screen. Is it 1V or something else? I've got only one answer. What about the rest? When you press second 8, what's on your screen? Type it on the chat box. Let me know. Okay. I've got another Lin. Okay. What about the rest one? Only 2 people have answered. Lin, 1V. Okay. 3. Okay. Yes. Now, guys, you need on the screen 1V or 1 minus V. Some people say it's actually 1V. If not, keep pressing second enter until you get 1V. Keep pressing second enter, second enter, second enter, second enter until you get 1V. Second enter until you get 1V. Once you get 1V, press down arrow. Is your N3? Then you get X bar, that is mean 5. Then you get SX. S stands for sample, which is 4.58, or roughly, what should be my answer? Guys, don't fall into the trap. The answer is not B. Why? Because they're asking for variance. Variance is a square of standard deviation. So on your screen, it is 4.58. Press X square, X square. When you press X square, that's where you get 21. Variance is percentage square. Are you getting me? Many students would choose 4.6, which is standard deviation, which is not right. They are asking you variance. Got it? Got it? Got it? Check, 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 check. Understood? So the answer is A, because they asked me variance. Variance is always in percentage square. So on your screen, when you get the sample standard deviation, just press X square. Perfect. Clear? Yes. Next one is very easy. I'm sure everyone can answer this. A distribution with a mode of 10 and a range of 2 to 5 would most likely be. Now, there are various ways through which people solve this. When they say range, so the lowest value is 2, the highest value is 25. What will be the mean? Can someone tell me what will be the mean? Can someone tell me what will be the mean? Mean, not the mode. What is going to be the mean? 21? No, it has to be the gap, average of the gap. The gap is 23 divided by 2. So the mean has to be 11.5. Am I correct? Right? And they said the mode is 10. The mode is 10. So guys, the mean is bigger than the mode. When is the mean bigger than mode? When is the mean greater than mode? When it is, yes. Which skewed? Mean is bigger means it's positively skewed. Am I correct? Check, 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 check. Understood? Interesting, isn't it? All these are, questions that, we used to get these WhatsApp chats, IAS type of questions or IIT questions. These are something like that, logical reasoning. Understood? Correct? All set? CFA is so easy, isn't it? So easy. Level 1, isn't it? Level 1 is so easy. Of course, if you're with me, it's very easy. Together, it's easy, isn't it? See, when you pass level 1, I've seen those who pass level 1, they tell everyone, oh, level 1 is so easy. Level 1 is so easy. The same guys, I've seen them struggling in a very tense situation. Once they pass, they become influencers on social media. What is my level 1 strategy? How you should pass level 1? So, you always need to understand that there is also a very important element in passing, that is luck. I don't say there is no hard work, but some people going on chat GPT, writing the strategy, phrasing that and putting that on LinkedIn, it's very dangerous. Okay. I don't say that what they've done is wrong. They might have done what is right, but you always should make up your own strategy. Understood? Not waste too much of time in understanding someone else's strategy, because everyone goes through a different stage. So, all this influencer stuff, all that avoid. It's easy if you don't overthink and just keep following the process. Okay, next, a distribution that has positive excess kurtosis. I think there is typing error. Positive excess kurtosis. Positive excess kurtosis is, by the way, it is more peaked than the normal distribution and has fatter tails. So more peaked, yes. By the way, can someone tell me what is that called as? What is the name of that positive excess kurtosis? Come on, everyone. It's called leptokurtic. isn't it? And what is the kurtosis minimum for normal distribution? What is the kurtosis size?
Meso.
3. Anything greater than 3 is lepto. Got it, everyone? Check. Lepto is more peaked. Meso is normal distribution. Platy is less peaked. Got it? Okay. Now, the next, you have two questions dependent on this data. One is the standard deviation over the last 10 years. And then second is target semi-standard deviation over the 10 years. First, we will calculate the standard deviation. Go to second 7 and second clear. Second 7, second clear, you have to do hard work. You have to put all the numbers x01, x02, blah, 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 till the 10th. Start doing it, everyone. 1.5, enter. 6, enter. 1.5, enter. 2, negative, enter. 0, enter. 4.5, enter. 3.5, enter. 2.5, enter. 5.5, enter. And last 4, enter. Second 8, it should be 1V, down arrow, sample, standard deviation for the sample, right? Because it's 10 years. Let me know. What's your answer? Are you also getting the same answer? 2.5276. 2.5276. You should get this. If not, all you need to do is start praying the God. Understood? Are you getting this? Check. Everyone. Hello. Anyone there? Lost? Network gone? Check. Suddenly the class has become silent. Speed. X01, X02, right? Perfect. That's standard deviation. Now, what is target semi-standard deviation? Watch it out carefully. In target semi-standard deviation, they have given you a target return of 2%. So you will only take those values which are below 2 because it's the downside deviation. What are the values which are below 2? Third year, fourth year, fifth year, anything else below 2? No. Only 3 values. So now this is what we will take into the calculation. Target standard deviation has no calculator function. You have to do it manually only, like mad, mean absolute deviation. So here, only these 3 values you need to take. 1.5 minus the target 2 square. Minus 2 the square, 0 minus 2 the square. Why 2? Because that's a target. I'm looking for the downside deviation below that. Guys, just add all this. So 1.5 minus 2, then I do the square. This is 0.25. 4 square, this is going to be 16. 2 square, 4. So it's 20.25. But this, very interesting, you have to divide it n minus 1. N is 10. So 10 minus 1. This is what you will have to divide it with. And then do the square root. There is no shortcut for this. There is no calculator function for this. You have to do it manually only. So 20.25 divided by 9 and then press square root, you will get 1.5%. Are you with me on this? Check, confirm. Everyone? Got it. Everyone? Understood how did I derive this? Clear? Yes. Okay. Everyone. So actually the first 3 topics has more questions. As I said, in exam, you can expect 1 question from each topic. Okay, everyone? But sometimes, they might ask you 2 questions from some of the topic, but they cannot go beyond that because of the limitation. There are 11 readings. So maximum they will ask you 1 or 2 questions, not more than that. Got it?